Hey everyone, this is Dan. It's around 10:40 a.m. Tuesday, February 23rd. The market has been going down for the last 4 or 5 days. Let's talk about how we can protect ourselves from a potential market crash. This is the daily chart for SPY, which corresponds very well with the S&P index. We can see that the market has been going down for the last 5 consecutive days, including today. And this chart was printed at 9 a.m. this morning. In the meanwhile, we see a bearish sell signal from the DMI indicator as of yesterday, and this morning we see a sell signal from MACD. These are very bearish signs. Let's look at the hourly chart. This chart was printed at 9:15 a.m. this morning. I see this downward sloping channel in the last 4 or 5 days. Again, it's a very bearish sign. We also have this sell signal from DMI as of this morning pre-market, and confirmed by the sell signal from MACD. And there are various sell signals here in the last few days as well. There's no question that the market has been heading down. At this point, it's hard to tell when it's going to turn around. You might say that there's not going to be a market crash because there's a pandemic out there. The government is trying to do everything to support the economy, especially the Federal Reserve Bank will buy U.S. Treasuries and mortgages, thereby increasing money supply in the market. In other words, they will continue the quantitative easing to turn the market around like what they have done in the last few years. Or you might say the government has given out stimulus checks in the last couple of years. They will continue to hand out more stimulus checks. And then people with more money on their hands will start spending money and the economy will go up and the market will turn around. But there's a big but. You might notice that back in February of 2020, which was last year, when the pandemic hit the US, the Federal Reserve Bank did try to save the economy and save the stock market when the stock market started to crash at around February 23rd. However, by the time the QE measures started to kick in, that was mid-March, the market was already down more than 20%. To turn the sinking market around, it's like trying to stop a boat, a very big boat. And that's why the market did not turn around until the end of March. Typically, it'll take even longer for the Congress to pass a stimulus bill. And then, of course, President Joe Biden will promptly sign it. But it'll probably come even slower than any help that'll be coming from the Fed. And that's why I've decided to help myself instead of waiting for the Fed or the federal government to bail me out. And here's what I've done yesterday and today in relations to what I've seen in the market. Yesterday, I sold some of my BNTX shares and shares from Royal Caribbean, from Southwest Airlines, and Airlines ETF, JETS. Because yesterday we saw a sector rotation. Even though about 8 out of 10 stocks dropped yesterday, the recovery sector and some of the biotech stocks, such as BioNTech, and the financial stocks as well as energy stocks were going up. But this morning looks like almost everything is going down. That means the drop is accelerating, and that's a very ominous sign. In addition, this morning I sold Bitcoin and some of my ASML shares. Both of them have been dropping. Fortunately, I bought them at much lower prices, and that's why I sold to lock in my gains. And I also bought some SQQQ this morning. You might know that SQQQ is a triple inverse ETF indexed to the NASDAQ 100. So when the market goes down, SQQQ goes up, and it goes up 3 times faster than the market is going down. So far, I'm seeing a small paper gain on that already. If the market continues to go down in the next few days, I will sell more stocks in my portfolio, such as TSM Taiwan Semiconductor, QCOM, which is Qualcomm, ASML, Amazon, Microsoft, the ARKK and ARKG ETFs as well. And I will continue to reduce my long positions and increase my short positions if the market continues to go down. I will, however, keep some of the shares of companies with good fundamentals for the long term, such as TSM, QCOM, ASML, Amazon, and Apple. Since I have the GLD ETF, the gold ETF in my portfolio, I will continue to keep my GLD shares as a safety hedge. On February 11th, I made a video about the very strong resistance that we would encounter when the market approached S&P 4000. And I talked about a potential market crash and what we could do to protect ourselves from a market crash. The things I said in that video are extremely pertinent today and in the near future. And that's why in the next few minutes, I will show you some of the slides from that video. This is the S&P chart from 2011 to 2021, a 10-year period. We are right here approaching 4,000. What happened when we approached the last milestone of 3,000? Here. As you can see, the index went up, approaching the 3,000 mark, and then it came back down, went up again, came back down in a big way, up again, down, up, down, and then finally it got above the 3,000 point. It took altogether more than a year and a half to get above 3,000. And during this year and a half, we experienced a dip that was 20%. So that was a heck of a scary ride. How about the 2,000 mark? Here, again, started in the middle of 2014. We hit that line, came down a little bit, got a little bit above, came down again, got above by about 5-6%, but eventually came down. And it took altogether a year to be solidly above 2,000. And during that time, we experienced a dip of 15%. If you have enough confidence to hold on to your long positions throughout these pretty significant dips, then you would have survived. However, if you had sold at the wrong time, you might have lost. How do we minimize our losses during those dips when we encounter these major S&P 500 milestones? And how can we even profit from it? I'll explain my strategies. Before we move on, I'd like to mention that I will very much appreciate if you can click the like, subscribe, and notification button for the sake of the YouTube algorithm. Let's move on. Let's look at Google Trends, which is a very handy-dandy tool to predict imminent market crashes. So when those dips are starting, I want to be able to tell within a few days that I should get rid of my long position or maybe even start assuming short positions to benefit from the dip. This is the Google Trends chart in the last 24 hours. I generated yesterday, February 10th. I used two search phrases: best stocks to buy, that's my bullish indicator, represented by the blue color, and market crash, that's my bearish indicator, represented by the red color. As you can see, yesterday, right around here, at 10:44 a.m., February 10th, the bearish indicator spiked and got above the bullish indicator. So that was bad news for the stock market. So what happened to the S&P 500 chart? Right here. S&P in the morning, right around 10 a.m. started to dip, and it bottomed out at 10:45 a.m., right when the red line peaked out, and then it started to recover. That's indeed a very good correlation between Google Trends and the S&P chart. Actually, if you are holding any stock that has fairly good correlation with S&P 500, in other words, any stock with a high alpha, you would most likely see the same pattern. That's why whatever techniques I'm talking about here, I will be applying to most of the other stocks in my portfolio as well. Let's look at Google Trends for the last 12 months. We can see that there are a couple of peaks here. And if you look at the S&P chart, during this first peak, that was a week of February 23rd to 29th, 2020. And that's the start of the famous pandemic dip. S&P 500 just started to dip right around that time, February 23rd, 2020. The second peak is still in the week of March 8th to 14th. That's the beginning of that week. The stock market continued to go down. And then finally, the bearish indicator subsided and got below the bullish indicator during the week of March 12th to 28th. And S&P 500 bottomed out on March 23rd, 2020 and started to recover. Again, we see very good correlation between the Google Trends chart and S&P 500. In addition to using Google Trends, I'll be using a few other indicators to time my buy and sell orders during a crash. That crash, by the way, was 35%. That would have been nice had we been able to take notice of these indicators and act accordingly to avoid losses or even profit from it. This is the Google Trends chart from this morning, February 23rd. We can see there were two spikes this morning, the first one at 5 a.m., the second one at 9 a.m. And here's a chart for SPY. As you can see, we had the corresponding dip here. The red spikes here indicate a bearish sentiment. That's why if we see more of these red spikes in the next few days, we can possibly see a very serious crash coming. In addition to using Google Trends, I will be using other technical indicators to help me avoid losses or even profit from future market crashes. Let's look back at the period when the market was trying to get above S&P 3000. Let's start with here. When it approached the 3000 line and started to dip, if we look at the RSI, DMI, and MACD indicators, what signals had we received? And that dip, by the way, was 20%, very substantial. First of all, we saw a warning from RSI indicating that the market was overbought. And then shortly after that, we got the sell signal from both MACD and DMI almost simultaneously. That point lined up pretty well with the start of this dip. And then later on, we got a buy signal and a sell signal from MACD, and really didn't get any signal from DMI, although we do see the movement of the blue line versus the beige color line. Had you follow these two signals and bought here and sold there, you would have been just breaking even, not lose money a lot, not made any profit either. But this signal from MACD was significant because it lined up very well with the start of the recovery. Maybe just lagged behind for a few days, actually for about 4 days. And then about 3-4 days later, we got the buy signal from DMI, although it came a little bit late. So MACD would have worked a lot better than DMI at that point. Had you followed MACD, you would have sold at this point and then bought in at that point almost 15 to 70% lower. That means you would have made a profit to the tune of 16 to 17% had you followed MACD. Then for the rest of the year, we saw these additional signals that averaged out to about one trade every month, which is quite reasonable. If you're looking at this video a few days after February 11th, you should also check the update section below this video in case I have entered any update notes. I'd like to remind you again to please click the like, subscribe, and notification button. Thank you very much. As usual, I will welcome your comments, questions, and suggestions. At this point, I'd like to remind you that I'm not a financial advisor. You should make up your own decision when you buy or sell financial instruments, and you should probably consult with your financial advisors before you do so. This wraps up my video for now. I will chat with you again in the next few days. In the meanwhile, I'd like to wish you the very best of luck with your financial investments.